Welcome, everyone. Today, we're here to talk about Magnifi by TIFIN, a marketplace where you can harness real-time proprietary data to help individual investors and financial advisors find, compare, and buy investment products like stocks, ETFs, mutual funds, and model portfolios to grow and preserve your wealth. I'm Melissa Francis. I know a little bit about this subject as a former CNBC, MSNBC, Fox Business, and Fox News anchor. And we have spoken about the best crypto investments with Anthony Scaramucci, the best equity strategies and investments with hedge funder Kyle Bass, and the best bond strategies with the bond king himself, Jeffrey Gundlach. And now we have a very special guest to talk about private equity investments, Marty Nesbitt. He is co-CEO of the Vistria Group, which is a Chicago-based private equity firm. He is also on the board of directors of publicly traded companies like CenterPoint Energy, Norfolk Southern Corporation, and American Airlines Group. Marty, thank you so much for being here. First of all, tell us a little bit about Vistria, some of your founding principles, and maybe some of your current assets, or maybe the deals you like the most.
Yeah, sure. I'm happy to do so. Vistria was kind of birthed from a set of personal experience by my co-founder, Kip Kirkpatrick, and I, who had both been sort of in the investment world, in public service, and obviously operate as entrepreneurs. And we thought, as we harvested our experiences, that at the intersection of public and private interest, there was a value proposition that we felt hadn't been recognized in the marketplace. And so we thought if we invested at the intersection of what was important to the public and what was important to the private sector, we could figure out how to harvest value. So we thought about the three industries where that opportunity set was greatest, and settled in on healthcare, education, and financial services, where we thought the value or the opportunity set was greatest. And so Vistria is a name that we made up because that's one of the hardest things there is to do when you start any business, is find a name. But it means the power of three. And it's the power of investing with the requisite amount of investment experience and expertise, the requisite amount of operating expertise, but then also a long-term policy perspective so that you can invest in places that are not only good for the businesses, good for employees, customers, and investors, but also good for the broader public. So that policy perspective is the third dimension that we invest behind.
Yeah, no, I mean, that brings up so many questions. Let me start with just a few. Private equity in general, you see really great outsized returns. How do you keep that up when stocks and bonds are having such a rough time like they are right now?
Well, look, one of the beautiful things about building a private equity platform is the opportunity to be really focused in an industry or a subsector of an industry where you can develop real expertise. And so we spend a lot of time developing themes that we want to invest behind, and then going very, very deep so that we know the levers to create value, what the long-term proposition is. And so even in an environment where we see prices rising, as there's so much capital competing for these opportunities, we have confidence about the value creation plan we can put in place and the way that we can generate our return objectives in a very difficult, challenging pricing environment. So being focused is a way to mitigate some of that risk.
You know, I also noticed that when you talk about the sectors that you're in, so some of them are really dependent on what's going on in the economy and focused on the consumer. Some of them, you know, like healthcare, you kind of need that no matter what. So was that intentional that you have that mix? And what is your outlook on the economy right now for those, you know, things in your portfolio that are affected by the economy?
Yeah, we picked these three industries: healthcare, education, and financial services, healthy, wealthy, and wise, because we believe that they are the cornerstones for any growing, thriving economy. Nobody, no policymaker is going to try to create long-term policy that disrupts these industries in a way that becomes a hindrance to the economy. So since they are the backbones of the economy, I think you can rely on their resilience, their support, importance to both consumers and to policymakers. So there's less volatility around them and a more reliable long-term value proposition.
So I didn't hear in there, though, if you think that we're headed for a recession right now. I want to get your read on what you think is going on in the economy, because some people say feels like we're headed for recession. It could be small, it could be really big. And are you making any changes in your portfolio based on that?
Well, look, nothing lasts forever. And we've been in a sort of growing economic environment for over a decade now. A rough patch is certainly going to come at some point. I think, and there's nothing you can do to avoid it. There are probably some spaces where you're going to see more volatility, more revenue risk, more risk on operating costs, and therefore EBITDA, but others where there's more stability. Healthcare obviously is one of those spaces. Education also another one of those spaces. Probably a little bit more volatility in financial services and a rising interest rate environment. That space will be disrupted a little bit more in any impending recession. But the ability to have a commitment and focus on where you believe there's a real long-term value proposition is one way to mitigate that risk. So we try to stay focused on areas where we know, in spite of economic ups and downs, that there's still a long-term value proposition, a long-term opportunity to grow a business in a given space. And so those opportunities abound in healthcare and education especially.
What I hear you saying is that you stay disciplined, and that's really hard when things are moving up and down and you're looking at your returns. What do you say to yourself? I mean, when you look in the mirror, how do you convince yourself to stay really disciplined? What advice would you give to people out there who are trying to do the same thing?
Yeah, look, we have to, we challenge our deal teams to stay true to our objective of delivering, 3 times our money in 5 years or a 25% IRR. And if they can't come to our investment committee with a compelling value creation plan that convinces us that we can really drive EBITDA growth in a space and reach our return objectives, we just don't do it. We have to have an edge. Now, we try to stay focused on themes that we've invested years in developing. So real conviction around where we want to be, but then a clear roadmap to create value in those spaces, either by being more efficient, driving top line revenue, or leveraging a set of strategic relationships that might help us create value. So really being disciplined. Now, just because you pay a high price for something doesn't mean you overpay, right? But in a rising price environment, you really have to have conviction around what your plan is to create value.
So I'm glad you bring up the idea of a plan, because a lot of individual investors have been told, you do that 60-40 split. But it seems like maybe that model is a little bit out of date at this point. I mean, do you feel like you need to include private equity? What do you think as an investment? What would you tell an investment advisor they should say to their clients about the 60-40 proposition at this point?
Well, listen, I think private equity is a great space to invest. You are not hindered by the dynamics that you face and the challenges you face in the public markets, quarterly earnings, constraints on delivering cash flow and dividends. You do have the capacity to stay focused on value creation. You're not constrained around capital that you can invest. You don't have to worry about delivering short-term EBITDA targets. You can be focused and committed to the long-term value proposition. And so I think having the requisite amount of private equity in a portfolio is important, and a way that I like to say also in the middle market, particularly in private equity, even when you face macroeconomic hurdles, challenges, headwinds, you can always put in a little bit more elbow grease. There's always a little bit more insight, a way to defy the dynamics of sort of the macro economy to just eke out a little more value without being so constrained on I got to deliver next quarter's earnings. And so critically important to me to have that kind of value driver in any portfolio.
Yeah, I mean, of course, you have to have a long-term time horizon because it takes so long to exit. And talk to me a little bit about some of the organizations or some of the deals that you've been involved in and how they sort of exemplify what your thesis is, maybe Full Bloom or Penn Foster or your choice.
Yeah, look, I love the Penn Foster example. Penn Foster was a business that had been around for a long time, but it was outdated, really wasn't optimizing the product that it offered to the marketplace, but for us was an ideal investment. It was a online high school completion business. It was not a GED, but it offered its students an opportunity to earn a high school degree. Now, it was birthed post World War I, where GIs were coming back from the war. They needed to finish high school, and they did it, of course, through correspondence. And it morphed over time into kind of an online PDF sharing of lessons and then an exchange of homework and testing by sharing files. We invested in this business, created a more interactive online experience for students. We used animation and video and other ways to ease the learning process and create greater outcomes. But we also recognized that there was really three beneficiaries to the product. One, the students who were actually getting a degree and being more prepared to enter the workforce at that entry level. Two, the employers who had a lot of undereducated, underskilled entry-level employees, and they needed them to have more potential to grow through the company. So that second constituency that was important to the process, but also the public at large, because an undereducated citizen is a burden on the rest of us. And so a product that actually served the taxpayer too. That was a perfect situation for us. We actually made our profits by preparing students to work it to lower the unemployment rate and serve corporations and help them become more profitable and have better prospects for their supervisor and manager positions in the middle market. So a perfect sort of middle of the fairway deal for Vistria. We say within our firm, if we can make money making the world a better place, two things are going to happen. We're going to make money and the world's going to become a better place. And that deal was a perfect example of sort of how that wise piece of our healthy, wealthy, and wise mantra can be invested behind.
Although you mentioned politics, and I know you've obviously dipped your toe into politics at times, when you talk about any of the for-profit education, it's gotten, a lot of heat, and it's not necessarily considered risk-free for investors. How do you navigate your way around that, and what does it mean for your exit?
Yeah, look, we try to be authentic in what we're trying to accomplish. And we're looking for, on the education side, how can we better prepare students, trainees, or whatever for the workforce? How can we do that in a cost-effective way for them or their employers? And how can we improve outcomes, the rate at which these students are having success? And so when we think about those objectives and align them sort of long-term policy objectives, we want our students to get a good ROI, then we don't worry about sort of those headwinds if we are actually delivering a service or a product that is consistent with long-term policy objectives. We use our insight on policy to navigate those risks, not to take them on, right? And there are certain things in the for-profit education sector that are a critical part of the infrastructure for our education system here in the U.S. And so we believe, like, as long as we're doing the right thing, that we'll be fine over the long term. And there are certain cases like that in healthcare, for example, where those long-term policy objectives are what we try to align ourselves with. We try to navigate around short-term risk and stroke of the pen risk. We avoid those.
And it's where your reputation really comes into play. If you have a reputation for doing the right thing, then you can get past, some of those hurdles. Let me ask you about private equity in general. Obviously, it's very sexy, something people love to talk about, but it's not available to everyone, obviously. Generally, large institutions are able to get in. What do you think about it as an asset category? Are you pursuing more retail outlets? Should it be that kind of investment?
Absolutely. Look, I think with the right distribution through the right credible sources who know how to diligence a PE platform and offer good products to the retail community, I think there's a great opportunity. We pride ourselves. We have a few relationships there. We always make at least some part of our fund available to retail investors through some of our partners. But I think that opportunity set is just going to grow, and there should be increasing opportunities for smaller accredited investors to get into private equity.
Yeah. Well, thank you so much for joining us, Marty. Really great stuff. For more information on private equity and anything you have heard here today, please go to magnifi.com/media. We'll be right back.
Thank you.
Welcome back, everyone. I am joined by Gary Kaminsky, former vice chairman at Morgan Stanley, former capital markets editor at CNBC. Gary is also an investor and a board member at TIFIN. Gary, welcome. Thank you for joining us. I know you were listening to Marty Nesbitt, who we just had on. You and I have talked in the past about how we think that maybe that 60-40 model might be broken. What do you think about what he had to say about it and where private equity fits in?
Well, first of all, Melissa, was a great show, so enlightening and so informative. And I do think, as we've seen what's happened year to date in terms of the equity markets and the bond markets, and we're clearly in an interesting time to be an investor, with interest rates going up at the same time the economy is dramatically slowing down. I think Marty laid out exactly the case for why private equity benefits as an asset class in an environment like this. And I do think that it's being talked about at every investment firm right now, as far as what percentage of one's total invested in portfolio needs to be allocated to private equity. And the key factor that he mentioned was the fact that you don't have to be managing businesses quarter to quarter for publicly reported earnings in a private equity business. And I think the phrase was elbow grease. There's always an opportunity to make the operating performance of the businesses outside of the public view that much better. And at the time when the equity markets are welcomed for exits, that's when you monetize for your investors. So just a great overall explanation of why that asset class is a good diversification outside of traditional stocks and bonds.
I've interviewed so many CEOs who said that once they went public, it became such a distraction to constantly have to report earnings, to deal with, how it was being perceived, not just what your returns were, but what the perception of what you were doing was. It really makes it harder to do the best with your business. So I think that's what you're saying. With private equity, you kind of get the advantage of the company focusing specifically on what they do best. I think one of the drawbacks in the past, and one of the reasons why I love Magnifi, is because the average investor, you can't get into private equity. I mean, that's something where you have to be, high net worth individual, professional investor. But it is remarkable to me that there is a way to go on Magnifi and say, how do I, expose myself to private equity, right? How would I do that?
Well, right. Again, if you can't invest, if you don't meet the minimum thresholds, and Marty did talk about the fact that there are retail distribution channels opening up so that individual investors can find more access. But if you're not able to even access private equity directly, through the beauty of something like the Magnifi search bar, you can type in, I want to invest in publicly traded private equity ETF, and you'll be able to identify those publicly traded companies that are solely in the business of private equity. And so while it's not exactly apples to apples, you're not investing in the private equity deals, you're investing in the private equity businesses that'll hopefully benefit not just for the limited partners, the private partners, but the public partners, as all of these companies, as you know, have gone public over the last decade to access permanent capital. So Magnifi takes you there through the search bar.
Yeah, no, it's amazing. It's a way to get access to it. So you would put in the search bar, for example, how do I invest in private equity through an ETF? Let's do that. See what happens. It's pretty easy to get this information on the Magnifi platform. So what ETFs to invest in? It's sorted by returns. Let's see what it says. PSP Global Listed Private Equity, that's one. And VPC Private Credit Strategy. What do you think about that?
Again, these are great examples of how you can access those companies or those investments that are going to benefit from not just the growth of assets under management, but the growth of performance and capital appreciation. And so a good example of how retail investors can participate. And, you know, just in terms of the timeliness of private equity, Melissa, in the opening with Marty, you talked about the 3 prior shows we had done. And before we began this program today, I just kind of wanted to look back and think about, you know, what's happened with the oil market since we had Kyle Bass, what's happened with crypto since Anthony Scaramucci had joined us, and really what's happened in terms of the bond market since we had Jeffrey Gundlach join us. And, you know, it's always good to have informative content, but it's also pretty good to have correct content, information that has actually proved to be correct. And so I think as we watch what happens the rest of this year, these volatile markets, I, for one, putting on my former investment manager hat, I think the private equity is going to be the one area that's going to have quite a bit of dispersion from the traditional public equity markets. I think everybody should focus on that.
And I'm going to put you on the spot for a second, but I mean, if you're talking 60-40 and then you take away and you add in that new piece of private equity, especially given the environment right now, what would you do yourself, or what would you tell your mom to do?
Well, my mother is very, very conservative investor. I think she's 100% in bonds. And don't invest in 100% bonds. But that being said, I think the traditional model 3 to 5 years from now across Wall Street is going to be closer to 50 equities, 30 fixed income, and 20 in private equity. And if interest rates really do go back up to some levels where you can actually look at a total return portfolio, increase the fixed income exposure, I think you're going to stick with 20% in private equity, and that money's going to come out of traditional equity. So maybe 50, 30, 20, or something like 40, 30, 30. So I do think that the growth in private equity here is going to be the fastest growth in terms of asset allocation, in terms of asset classes.
Yeah. You know, it's an exciting time. There's so many more ways to invest than there used to be. You brought up some of the things that we talked about, crypto. It's to me, it's really of great value that now there are all of these different plays, whether the economy is going up or down, and Magnifi gives you a great way to go in and really do the research yourself and figure it out. Gary, yeah, go ahead. Last word to you.
No, I was going to say absolutely. That's the beauty of having this access. As I said in the past, you're not distracted by the noise of a salesperson. You're not distracted by the noise of, you know, somebody recommending an ETF because that person got taken out by a wholesaler, and that recommendation is simply based on who socialized with who. This is completely objective, and it just gives you the information based on what the asset class is doing. So that's why we love it.
All right. Awesome. Well, we want to thank our guest, Marty Nesbitt, today, and make sure you all visit magnifi.com/media to help identify the best private equity ETFs and all the best plays to grow and preserve your portfolio and your clients' portfolios. I'm Melissa Francis. Thanks for your time today.